I want you to imagine something for a moment. Every headline you read is positive. The market is near all-time highs. Indexes keep pushing up. Everyone around you is calm, confident, even excited. And yet, something doesn't feel right. I've been investing for a long time, and I've learned one thing the hard way. Markets don't become dangerous when people are scared. They become dangerous when people are comfortable. Because right now, the market looks strong on the surface. But underneath, the foundations are starting to crack. Let me explain what I mean. If you zoom out and look at the market as a whole, it appears healthy. Indexes are up, volatility is low, money keeps flowing in. But when you zoom in, you realize that most stocks are actually doing nothing. A handful of companies are carrying the entire market on their backs. The truth is, today's stock market isn't being driven by growth everywhere. It's being driven by concentration. Just a few mega-cap stocks are responsible for most of the gains you see on your screen. If you own an index fund, you might think you're diversified. But in reality, your future returns depend heavily on a very small group of companies. And this is where the first red flag appears. When markets are healthy, growth is broad. Different sectors move together. Different sizes of companies participate. But when markets are fragile, leadership narrows. And right now, leadership has become extremely narrow. History tells us that this kind of setup doesn't usually end quietly. Now, here's where things get more uncomfortable. A lot of the money pushing markets higher today isn't coming from confidence in long-term profits. It's coming from expectations. Expectations that growth will continue. Expectations that technology will solve everything. Expectations that central banks will step in if anything breaks. Markets are no longer pricing what is. They're pricing what people hope will be, and hope is not a strategy. Another warning sign shows up when you look at valuations. Prices have moved faster than earnings. Revenue growth is slowing, but stock prices keep climbing. That gap can exist for a while, sometimes longer than people expect, but it cannot exist forever. Eventually, either profits catch up or prices come back down. There is no third option. What makes this moment especially dangerous is psychology. Most investors today have never experienced a true, prolonged downturn. They've only seen quick recoveries. Every dip has been a buying opportunity. Every crash has been temporary. That creates a belief, a very powerful one, that markets only go up. And whenever that belief becomes widespread, risk quietly builds in the background. Because leverage increases, risk management disappears, and people stop asking hard questions. They stop asking, what happens if growth slows? What happens if rates stay higher? What happens if expectations don't become reality? Markets don't crash because of one bad event. They crash when the system becomes fragile enough that any event can tip it over. And fragility is exactly what I see right now. Now, let me be clear. This does not mean a crash is guaranteed. It does not mean you should panic. And it definitely does not mean you should try to time the market. But it does mean this is a time for humility, a time to reduce unnecessary risk, a time to focus on balance instead of excitement, a time to stop confusing rising prices with safety. Strong markets don't fail when everyone expects them to. They fail when no one thinks they can. And that's why I believe the market looks strong. But something is very wrong. If you understand this, you won't be the one panicking when conditions change. You'll be the one prepared. And in investing, preparedness is the real edge. In part 1, we talked about why the market feels strong on the surface, but fragile underneath. Now the real question is this: if something is wrong, what are smart investors actually doing about it? Because here's the truth most people don't want to hear. Smart money doesn't panic. Smart money doesn't post screenshots. And smart money definitely doesn't chase headlines. It moves quietly, long before problems show up in the news. Let me explain. When markets are euphoric, inexperienced investors take more risk. They concentrate their portfolios. They use leverage. They assume tomorrow will look like yesterday. Experienced investors do the opposite. They don't try to predict crashes. They prepare for uncertainty. Right now, the smartest investors I know are doing 3 very boring things. And boring in investing is often a good sign. First, they're reducing hidden risk, not selling everything, not going to cash, but asking a simple question: If this stock drops 40%, can I still sleep at night? If the answer is no, the position is too big. Smart investors understand that most losses don't come from being wrong. They come from being overconfident. So they trim, they rebalance, they make sure no single idea can ruin their future. Second, they're focusing on cash flow, not stories. In speculative markets, stories outperform fundamentals. In difficult markets, fundamentals take revenge. Right now, smart investors are slowly shifting toward businesses that generate real cash, can survive higher interest rates, don't depend on perfect conditions to exist. These companies don't sound exciting. They don't promise to change the world, but they keep paying even when optimism disappears. Third, and this one matters most, they're mentally preparing for discomfort. Because the biggest mistake investors make isn't buying at the wrong price, it's selling at the wrong moment. Markets test patience before they test intelligence. Smart investors know that volatility is not a sign of failure. It's the price of admission. They expect drawdowns. They plan for underperformance. They accept that doing the right thing can feel wrong for a long time, and that mindset changes everything. Here's the paradox most people miss. The goal isn't to avoid downturns. The goal is to survive them. If you can stay invested when others are forced out, that's where real wealth is built. This is why smart investors don't ask, will the market crash? They ask, if it does, am I positioned to benefit instead of panic? Because when conditions change, and they always do, opportunity doesn't appear with an announcement. It appears quietly when fear replaces confidence. And the people who win are rarely the smartest in the room. They're the ones who were prepared while everyone else was busy celebrating. In part 3, I'll explain what usually breaks first when markets turn and why the warning signs are almost always ignored. Because by the time everyone sees the problem, the damage is already done. Now let's go one level deeper, because when markets finally turn, they don't break everywhere at once. They break in specific places first. And if you know where to look, the warning signs are visible long before prices collapse. The first thing that usually breaks isn't stock prices. It's liquidity. During good times, liquidity feels infinite. You can buy anything, anytime, at a tight spread. Risk feels invisible, but liquidity is an illusion. It only exists when everyone agrees. The moment confidence weakens, buyers disappear faster than sellers, and suddenly assets that looked safe become hard to exit. That's why crashes always feel sudden, not because they come out of nowhere, but because liquidity leaves quietly, then all at once. The second thing that breaks is the weakest business models, not the obvious scams, not the companies everyone already doubts. It's the companies that almost work. Businesses that need constant cheap capital, rely on future growth to justify today's price, can survive only if conditions stay perfect. These companies thrive in optimism, but they suffocate when reality returns. And the market is ruthless when growth slows. Investors stop asking, how big could this become? They start asking, will this survive? That shift alone can destroy valuations. The third thing that breaks, and this is the most dangerous, is narratives. Markets are built on stories. Stories about innovation, stories about transformation, stories about a new era. Narratives don't die when they're proven wrong. They die when people stop believing them, and belief can vanish overnight. The moment investors realize that the future arrived slower than expected, confidence cracks. Not panic, not fear, doubt. And doubt is enough to change behavior. Spending slows, hiring freezes. Capital becomes selective. Risk tolerance shrinks. This is how downturns actually start. Not with chaos, but with hesitation. Another overlooked signal is correlation. When markets are healthy, assets behave differently. Some go up, some go down. But when stress builds, everything starts moving together. Diversification stops working. Positions that seemed unrelated suddenly fall at the same time. That's not coincidence. That's leverage unwinding. And leverage doesn't announce itself until it's forced to exit. Now here's the part most people misunderstand. Markets don't need bad news to fall. They need less good news. When expectations are extremely high, even good outcomes disappoint. Earnings can rise, just not enough. Growth can continue, just slower. Innovation can happen, just later. And that gap between expectation and reality is where losses come from. This is why the most painful market declines don't feel logical. They feel unfair, because nothing terrible happened. But something important changed: momentum. Once momentum breaks, psychology follows. And once psychology shifts, prices eventually catch up. If you want calm, honest insights that help you think clearly when markets get noisy, subscribe now. No hype, no panic, just long-term perspective that actually protects your money.
That's all for today. I hope you learned something new. If you did, please like, subscribe, and stay tuned for the next video coming soon. And thank you for watching.